Hey everyone, in this video, we'll present our effective trading strategy centered around key moving averages, designed to elevate your trading skills. Be sure to subscribe and click on the notification bell to stay updated with our latest content releases. Based on viewer requests from the comments, a recurring topic has been how to effectively employ moving averages. Drop a comment below to let us know which topics you'd like us to explore next, as your feedback guides our content creation. Firstly, let's define moving averages. They're indicators applied to charts to smooth out price fluctuations and highlight trends. Rather than getting bogged down in technicalities, what matters most is how we demonstrate practical applications of moving averages. Specifically, we focus on the exponential moving average, EMA, set at 50, commonly referred to as the 50 EMA. Access your preferred charting and trading platform and navigate to the indicators section accordingly. Add the exponential moving average to your charts and set its length to 50. In this case, we use 50, but there are more ways out to use different numbers. It's crucial to understand that indicators should never be used alone for trade analysis or entries. Instead, they should validate and reinforce conclusions drawn from price action. Moving averages serve several purposes. Firstly, they can provide supporting evidence for identifying bullish, bearish, or sideways markets. When the 50 EMA is above price, it suggests a potential bearish market and downtrend. Conversely, when it lies below price, it indicates a potential bullish market and uptrend. If the 50 EMA intersects with price, it signifies a sideways market or consolidation phase. Moving averages are valuable for signaling potential trend changes. For instance, during a downtrend, a breakthrough above the moving average line can signal a shift to an uptrend. Similarly, in an uptrend, a break below the moving average line can indicate a transition to a downtrend. Last, moving averages can act as dynamic support or resistance levels. In a bullish uptrend, observing price action around the 50 EMA through candlestick formations can provide insights into potential entry points. Integrating these insights into your trading strategy can enhance your ability to interpret market movements effectively. When price reacts to the 50 EMA as support in a bullish uptrend, it signals a potential long continuation trend. Conversely, in a bearish downtrend, if price reacts to the 50 EMA through candlestick formations, it indicates a potential short continuation trend. It's crucial to view these concepts as guidelines rather than rigid rules. Moving averages are not used in isolation for trade entries. They are combined with established price action to enhance trading precision. Now let's delve into incorporating the 50 EMA into your trading process. We utilize the 50 EMA in two primary ways, for trend trading and reversal trading. Let's begin with trend trading. Consider the daily time frame where a clear uptrend is identified by higher highs and higher lows in price action. To trade with this uptrend effectively, 1. Establish the uptrend based on price action. 2. Identify key support areas, such as the ones highlighted by reactions in the chart. 3. Confirm the strength of these support areas by noting the presence of the 50 EMA coinciding with them. 4. As price approaches these areas, observe for significant price action signals, such as candlestick formations. 5. Look for confirmation through candlesticks showing rejection or consolidation around the support area, like wicks sticking out or inside bars. This approach integrates the 50 EMA into a comprehensive trading strategy that considers both price action and indicator signals for optimal trade quality. A reaction to the area of support and the 50 EMA doesn't necessarily translate into a trade signal. Price can stall at these levels and even break through them despite the support and EMA presence. It's important to understand that while the overall trend may be bullish, the short-term trend can still be bearish and continue. For a more detailed analysis, let's consider both the daily and 4-hour time frames side by side. On the left is the daily time frame, showing the established support level and trend line. On the right is the 4-hour time frame, mirroring the same support level and trend line. Here's the process. Daily time frame. Identify the support level and draw a trend line over the short-term downtrend. Observe multiple rejections of the trend line. 4-hour time frame. Confirm the observations from the daily time frame. Note the bullish candle that breaks through the trend line, accompanied by a strong close outside of it. This bullish candle signifies significant buyer interest, validating the potential reversal signaled by the daily time frame. It's crucial to wait for such confirmations to ensure higher trade reliability, aligning with both short-term and long-term trend perspectives. Once you've confirmed the end of a short-term downtrend and validated the continuation of the larger uptrend, you can begin seeking entry opportunities on lower time frames. This confirmation typically follows reactions at areas of confluence, where traders enter long positions and short traders close theirs, creating upward momentum. Let's continue exploring this approach on the daily time frame, where a clear uptrend is identified by higher highs and higher lows in price action. Here's how you can effectively trade with this uptrend. Identify key support and resistance levels. Pinpoint a critical support level that has demonstrated multiple reactions and has acted as both support and resistance recently. These factors validate its significance. Utilize trend lines. Draw a key trend line that has seen multiple interactions in the past, enhancing its relevance. Identify high confluence areas. Look for areas where the key trend line, significant support level, and the 50 EMA intersect closely. This high confluence zone strengthens the potential support area. Focus on the price action as it approaches this high confluence area. Look for signs of price reacting, such as candlestick formations with prominent wicks. Remember, a reaction alone does not justify a trade. Further confirmation is crucial. Confirming short-term trend reversal. If the short-term trend is bearish, draw a trend line above the current downtrend. Wait for a breakout above this trend line to confirm the end of the short-term downtrend and validate the continuation of the broader uptrend. Seek early entries. Consider placing a tighter trend line on the immediate downtrend and switch to the 4-hour time frame. Look for signs of a trend change that could offer earlier and tighter entry points. Here's how you can compare the daily and 4-hour time frames for a comprehensive analysis. Daily time frame. Confirm the established support level, key trend lines, and the overall uptrend direction. 4-hour time frame. Verify the same support level, trend lines, and potential entry points for long positions following the confirmed directional bias. This approach not only ensures a detailed analysis, but also positions you to capitalize on breakout opportunities and momentum plays aligned with the confirmed trend direction. Remember, successful trend trading with the 50 EMA hinges on identifying and reacting to areas of high confluence, where market dynamics favor your trading strategy. Here's how you can effectively approach trading with the 50 EMA across different time frames, focusing on identifying key entry points and confirming trend changes. 1. Identify key resistance and support levels. Pinpoint critical resistance levels that align with the 50 EMA. When price approaches these levels, observe for reactions like candlesticks that touch or bounce off these points. Remember, reactions alone do not signal a trade. 2. Utilize trend lines. Draw both long-term and short-term trend lines to visualize the trend direction clearly. These trend lines help in identifying potential breakout points and confirming trend changes. 3. Compare daily and 4-hour time frames. Analyze the same resistance levels and trend lines on both the daily and 4-hour time frames for a comprehensive view. 4. Confirming trend reversal. When the short-term trend is established, whether bullish or bearish, wait for a breakout above or below the short-term trend line on the 4-hour time frame. This breakout confirms the end of the pullback phase and signals the resumption of the broader trend. 5. Executing trades. Once the directional bias is confirmed through the trend line breakout and pullback reaction, consider entering trades on lower time frames, like the 4-hour time frame. Look for breakout opportunities or momentum plays aligned with the newly confirmed trend direction. 6. Intraday entry strategies. For more aggressive and early entries, focus on using the 50 EMA across intraday timeframes. This approach allows for quicker responses to trend changes and enhances the precision of entry points. In summary, integrating the 50 EMA into your trading strategy involves meticulous analysis of key levels, trend lines, and timeframe comparisons. This methodical approach ensures that you capitalize on trend confirmations and effectively manage trade entries based on market dynamics and trend developments. Finally, let's explore the 4-hour chart, where the 50 EMA provides a broader perspective on market trends and reversals. This time frame suits swing traders looking to capture medium-term price movements and trends. Here, the 50 EMA acts as a reliable indicator of trend direction and support resistance levels over extended periods. Swing traders use it to confirm trend reversals and plan their entries and exits accordingly. Whether you're trading on the 1-hour, 15-minute, or 4-hour chart, the 50-period exponential moving average can be a game-changer in your trading arsenal. By understanding its role across different time frames, you can adapt your strategies to suit varying market conditions and trading styles. Thanks for tuning in. If you found this video helpful, don't forget to hit the like button and subscribe for more insights into mastering moving average strategies. Drop your questions and thoughts in the comments below. We love hearing from you. Until next time, happy trading.